Please like my video, share it, subscribe the channel. Lot of experience, time, study and learning has been involved in making this video. Watch the video till end. Hello, this is Amitoj. Today is 3rd April 2021. We are going to discuss about stock investments. Learning about stock investments, being live on the market is like learning to go to swim while going into ocean. Very dangerous. So you learn swimming, being in a very controlled depth of a swimming pool, maybe 2 feet, starting from 2 feet depth, going to 3 feet, 4 feet, and making your assessment about the parameters and various things and live parameters under guidance in a controlled fashion, under the guidance of lifeguard. But going directly to ocean to learn swimming is a sure shot death. Investments are in nature risky. Someone can lose entire money, have major losses, despite the fact that he has been into market and has been doing a decent enough investments, but certain events, certain situations can ruin all the investments and vision of profitability or anything. So this is a word of caution before we talk or discuss about anything. I'm not giving any tips. Please do not make your mind and take quick decisions based on my video or any discussion we have here. The market is very risky. This has ruined so many people's lives, but nonetheless we are going to discuss and see how it behaves and what are the possibilities here. Now let me discuss you an option strategy. Say I'm from a technology background and I have been looking at stocks with an open mind, not with certain sector or something. Let's get to say we are having some ABC tech company which has options, trades and sells and buys option is available in the market. So I'm from India. Let us discuss about NSE and in a broader arena. This is option chain analysis chart of HCL Tech. The price is around 1000 and the market has been volatile, and there are premiums around puts. These are the puts and this side is the call. So there are premiums at various prices, say around 1100, it is around 80 or something, and on the other side also, say on the 940 price, the premium is around 70s or something. So this is a top level idea about option chain analysis chart of HCL Tech. We'll set it as a reference point and discuss nearly the same scenario. So you have to excuse me for a little bit and understand in a broad nature what I am trying to explain here. So the stock price is around 1000, right? So I go and sell the put. HCL Tech has been consistently rising since April 2020, right? And there is a consistent rise, and then it hit around 1063, and suddenly operator smart money went for a different direction. So it went for down price, right? And again from here it went for a down price. So in such a volatile environment, for options writer or a person who sells options has to take consistent corrective actions. So those corrective actions can be any strategies. For example, today we will discuss short cut strategy. So if a person sells a stock option at 1100 at a premium of 100, right, for a lot size of 700, right? So he is going to make a money of around 70,000 for a lot. What we have been into market, the recent trend was that technology stocks or any stock for that what were rising and rising on the positive side of prices increasing all the time. So in that trend, somebody sold, say they sold HCL Tech put at 1100 at a premium of say 90, expecting that this would go out of money, say for a lot size which is at 700 for so we would say for easy 1000 size, 1000 into 90 is like 90,000 premium. But since this is a volatile market and operator and smart money went for a reversal of trend, that the stock went below 1000. So expecting at the what we had sold at 90, the premium went for 150, 140, something like that. So we were expecting that we would have a premium of 90, but similarly of the range, say now the premium is 50 more. So now we are looking at a loss of around 50,000. So this would create a nervous situation and create a scare. But under this scare, we have to have a right application. Rather than squaring off and accepting a loss of anticipating 50,000, we would work out a better strategy. We would get hold of our nerves and try to formulate something wherein we can neutralize our expected losses and hedge our situation here. Now since we now total premium in this case is 160. Now what is the break even point for my put? This is 1100 minus 160, it's around 940. Now I will only lose money when HCL Tech, when it closes below the price of 940 at expiry. In that case, call will be out of money and put will be in the money. The vision here is now my break even point with earlier was 1010 and now it is the break even point is at 940. Now the break even point is at 70 rupees down We are not expecting, our sentiment is so that we are not expecting it to fall below 940s. Now we have hedged our situation for the lower rates. Now for the higher rates, now if it rises in a call sold situation, we have 116. Now call we will lose money in call only if the price of the HCL tag goes above 1160, which I am expecting the chance is very less. So we only lose money on a sold call if price rises above 1116. The put would be out of money, but the call would be in the money. So we have a premium of 160 here. Now I have set a range. Now the range is from 940 to 1160. So this is the range, and I am expecting to close the stock to close between 940 and 1160. This range is the way it closes. My profit would be alright. Now we have expecting say three situations. Now at expiring, if the rate is between 1000 and 1100, the call would also be in the money and put would be also in the money. So we do not have to worry about the deliveries. The situation would be a square off. The premium we are getting is around 160 if we are selling at 11 and buying at 1100 and buying at 1000. So the loss is 100, but the premium is 160. So we would be earning a profit of 60 rupees. We are looking at is if case the share rate stays between 1000 and 1100, we are going to make a profit of 60 rupees. If the rate goes above 1100, the 60 rupee profit would keep lowering down and it would zero out when the share price at 1160, and if the price goes above 1160, then I will start making losses. Similarly, when the stock catches a downtrend, it goes below 1000, the 60 buffer would 60 profit would keep lowering, and if it reaches 940, our profits are zeroed out, and if it goes below 940, because of our sold output, we would start making losses. Now my range set is 940 to 1160, and between 1000 and 1100 it would be maximum profit would be at 60. So the maximum profit is around 60. It would depend on the closing, and maximum profit will fall down, and loss would be only if the price goes above 1160 and the price falls below 940. The way we initiated, we were getting very nervous, but we optimized ourselves by formulating a strategy by selling a call. Now this strategy is called a short gut, because we are selling both call and put. Now this strategy is called short gut. So if we have a better understanding to this level, that we can take corrective actions up as per the developing situation and prices, then only we are having some level to totally navigate the market. Now this volatile market will make us apply these understandings and studies in the market. So you can understand what level of understanding is required and how dangerous the situations can develop and how we would hedge ourselves. So we have to be very careful, alert, and understand all these things to save our investment, save our money. So you don't have to invest your money which is on which your life is dependent. You can only put a little bit of money which you are all ready to lose. You are ready to lose. So you are not to invest your money on which your critical life events, they will the money will provide security to those events. Only a little bit money which you can afford to lose. So all the best, guys. Like my video, share, and try to understand. Please do expect there may be some error in communicating or describing this situation. We provide scope for that. We'll end the video for now. Thank you so much.
Let's have a final methodical approach to short guts option. Study it. This is short guts option image. The maximum profit is equal to premium received. This is a short put strike price. This is short put call price. Profits decline below this. If the price rises above this price, profits decline. So short guts is a neutral strategy in options trading that involves the simultaneous selling of an in the money call and in the money put of the same underlying stock and expiration date. Sell 1 in the money call strike price, sell 1 in the money put strike price. This is a limited profit, unlimited risk options, unlimited risk. Again, I want to highlight this unlimited risk options trading strategy that is taken when the options trader thinks that the underlying stock will experience little volatility in near term. The short guts is a credit spread as a net credit is taken to enter the trade. Profit potential is limited profit potential. Maximum gain for the short gut strategy is limited and occurs when the underlying stock price on expiration date is trading between the strike prices of the options sold. At this price, while options expire in the money, they have lost all their time value. In this loss in time value and short guts strategy aims to capture as profit. The formula for calculating maximum profit is given below. Maximum profit is equal to net premium received plus strike price of short put minus strike price of short call minus commissions paid. Max profit achieved when price of underlying is in between the strike prices of the short call and short put. Unlimited risk. Unlimited risk. Large losses can be experienced when underlying stock price makes a strong move either upwards or downwards at expiration. For any reason, if there is a strong move beyond these limits, the formula of calculating loss is given below. Maximum loss is equal to unlimited. Loss occurs when price of underlying less than strike price of short put minus net premium received or price of underlying greater than short call plus net premium received. Loss is equal to price of underlying minus strike price of short call minus net premium received or strike price of short put minus price of underlying minus net premium received plus commissions paid. Break-even points. There are two break-even points for the short puts guts position. The break-even points can be calculated using following formula. Upper break-even point is equal to net premium received plus strike price of short call. Lower break-even point is equal to strike price of short put minus net premium received. Please excuse me for any errors.
Like my video, share and subscribe the channel. Many thanks. Thank you.